Following the COVID-19 outbreak in January, we hear market experts globally discussing about the pace of economic recovery. Some countries have emerged from lockdowns. What does this mean for investors? We have Robert Sinclair, strategist from Fullerton Fund Management with us. Hi Robert, do you see a V-shaped recovery still unfolding?
Thank you, Sharon. Yes, our expectation of a short but painful global economic recession does seem to be playing out. China is leading the recovery with its GDP growth returning to positive over Q2. The rest of the world is lagging, but overall we expect the global recession to end around Q3 with positive GDP growth returning to the US, Europe and the rest of Asia. The recoveries in unemployment and economic activity back to pre-COVID-19 levels is likely to be slower and could take several years. But investors should not be too concerned by that because the positive effect of the recession ending, the return to positive GDP growth, and of course the huge global policy stimulus is collectively having a very strong effect. Forward-looking markets are rallying on this and they expect stronger earnings growth to come through. What the slow recovery in unemployment does mean is that global central banks will be likely to keep interest rates low for a long time, but that should create an environment that is quite favourable to most risk assets. This chart overlays global share prices, which is the blue line, and they have rebounded significantly, with GDP growth forecasts, which are the bars, along with global earnings growth expectations, which is the green line, and they seem to be bottoming. Forward-looking equity markets appear to be well positioned for the global recession to end and for the recovery and earnings growth to come through.
With supportive backdrop for most risk assets, are there some key risks for investors?
Well, the most obvious risk for the next 6 months or so is that the COVID-19 reinfections surge again and we have to return to lockdowns. That risk is quite difficult to price in because markets are already adapting to this new normal COVID-19 environment, and if the reinfections were bad enough, then policymakers would be forced to launch more stimulus, but also to come up with new and better ways to manage the COVID-19 virus without being so draconian to the economy. The key risk for Asia is geopolitical. The US-China relationship has deteriorated a lot, and this could create a headwind for Chinese companies looking to expand their global market share going forward. The key risk for developed markets is that given unemployment is still quite high, markets would likely suffer a significant pullback if stronger earnings growth does not come through.
What are the key takeaways for investors?
Well, our risk appetite index is still quite bearish, which suggests that a lot of investors have missed much of the rally so far. So I think that as investors look to catch up and re-engage markets, they need to be selective but also cautious. We're positive on global risk assets and we're quite sanguine about the longer term fundamentals. We like global equities, Asia and especially China, and the sectors that we favour the most are those that seem to be best positioned to navigate the COVID-19 environment. So that's things like healthcare, consumer staples, utilities, and of course technology. With developed market yields being so low, fixed income opportunities in Asia and China in particular are quite attractive with a solid risk-reward balance and opportunities for diversification.
Thank you, Robert. If you would like to find out more about this topic, please read the latest Fullerton investment views on our website.